Hi everybody, welcome to the Parallel Systems broadcast. I'm your host Mike. Thank you for tuning in to today's special episode in which I'm going to be exposing one of the biggest banking scams that there is on planet Earth. And this is one that most people genuinely have no clue about, despite the fact that this banking scam is going to be responsible for the majority of people, yes, the majority of people losing 100% of their wealth in the coming financial crisis. So it's a real serious show. Listen in, share it with people that you care about, because I'm going to be giving you a bombshell episode here that's going to explain to you why your money in the bank is not protected. The scam I'm discussing, of course, is bank deposit insurance. And in today's video, I'm going to show people once and for all, why this scheme is one of the most dangerous and toxic lies of all the lies, and there's many, many of them, that banks and governments push on the general public. So what I'm going to do is I'm going to take you through the British version of this lie, which is the FSCS financial insurance scheme. And I'm going to show you once and for all why this scheme is a con, why it will not protect you in the coming financial disaster that we are all fastly approaching. And I'm also going to discuss with you, if you stick around to the end, I'll tell you the shocking details on exactly just how unprotected you are, how unprotected your bank deposits are, your pensions are, and this will help you to finally understand what you need to do to protect your wealth now whilst you still can before the next financial crisis hits. Okay, now before we begin, let's just discuss for a moment where deposit insurance schemes come from, and importantly, why they were introduced to begin with. Now, you might be tempted to believe that having your bank deposits insured is there to protect you. It's there to protect us, the public, from suffering losses in the collapse of a financial institution such as a bank. I mean, it makes sense, right? That's what they're doing it for. They're going to give you back that money if you lose it up to a certain amount. In the UK, it's £85,000. So it's there to protect you. Well, sadly, I'm here to tell you, my friend, if you think that, you are very, very wrong. You should have learned by now that these banksters 100% couldn't care less about you and I. No, the government and the banksters are not looking to protect us. If you'd been watching the Parallel Systems broadcast, you would know this by now. So stick around on this channel and I will teach you all about it. But these deposit insurance schemes are 100% not to protect you and I, and I'm going to talk about that in today's show. But the reality is actually quite the opposite. They are designed to protect the banks from us. Yes, you heard that right. They're designed to protect the bank, not you. And let me explain. So historically, when a bank was known to be in trouble, what would typically happen would be they would do their very best to keep quiet about it, to rearrange their funds, whatever they had to do. But once people got wind of it, or once the problem got so big that they couldn't hide it any longer, what would usually happen is a bank run, and you can see in this image on the screen here, this is a bank run. This is from the 1930s. Now, bank run is when people rush to the bank to withdraw all of their money because they are worried that the bank is about to go under. Because remember, when you put your money in a bank, you are essentially loaning that bank your money. You're giving that bank that money. They're holding it for you, but then they're lending it out themselves as well. And I'm going to talk more about that in a moment. Now, the big problem with bank runs is this can often be fatal for the bank in question. And you could argue also that in today's world, it would be fatal for the financial system in general, because it could quickly lead to contagion whereby a number of other banks then start to go under because they're all interlinked. There's lots and lots of counterparty risk within the system. Now, what you have to remember is that banks are uniquely prone to going bust in a bank run because they borrow short and they lend long. And what that means is that they take in demand deposits from you or I. So this is the money that we get paid for our salary and any income. We put that into the bank. Now, when we put that money into the bank, we are lending it to the bank. You have to understand this. When you put your money in a bank, you are loaning the bank that money. And then they in turn loan that money back out. However, when they loan that money back out in the form of giving loans to people, the maturity of those loans can be 2 years, it can be 10 years, it can be 15 years, it can be 40 years in the case of a mortgage. So what the bank is essentially doing is they are borrowing short by taking our money in the form of deposits. They're borrowing that from us and they are lending long. So they are lending that money out for the long term. And this creates what we call a term mismatch, which means that their balance sheets are inherently unstable. Because if lots of people all of a sudden arrive at that bank to withdraw their money, that money is not there. It's not in the vault. they've lent that money back out, and it's made even worse. It's made even worse because what we have today in banking is something called fractional reserve banking. So they only need around 5%, 10% of their exposure to the money they have lent out. So what that means is if you put £1 in a bank, they can lend 10 times that amount to other people. So do you understand? So when it gets down to it, they only have 10% of all the money that they've lent out at least. Now, some banks are even leveraged beyond that. Some banks are leveraged 20 times over, 30 times over, 50 times over. And that's not to mention the deregulation of banks, so that banks that take our money as deposits now also act as investment banks, and they can be exposed to all kinds of toxic financial products and derivatives. So essentially what you've got now is a banking system that is just built upon a house of sand, and it's going to come crashing down, as I'm going to get to later on in today's show. So again, this is part of the big lie, because the banks figured out a long time ago that most people will keep their money in a bank most of the time. So they've not only decided to lend out the money that we keep in the bank, they've lent out 10 times that amount, in the hope that lots of people don't descend on the bank all at once to withdraw their money and uncover the fact that the bank actually doesn't have that money in the vaults. It's lent it out, and it's lent it out 10 times to the amount that they've taken in deposits. And of course, it exposes to the public the whole scam, because people realize in a bank run that the bank actually doesn't have the money that it says it has, and that it has relent it out, sometimes 10, 15 times fold. And this is something the banks simply could not allow. This is something they could not allow. The central bankers and the commercial banks needed to come up with an idea to ensure that bank runs didn't happen and that the whole scheme was not exposed. So of course, whilst this dirty banking game is still in full swing and the banks are still playing at the casino, they needed something to ensure that as the system become less and less stable, as it become more unstable, as we come to the final days of this global fiat money Ponzi scheme that we've been on since 1971, when we was took off the Bretton Woods system, they needed a new trick to ensure that people didn't lose faith in the banks, particularly after the dot-com bubble burst, and then we had 2008, and just this year we've had pension funds almost go under. So people are going to have increasing opportunities as the system becomes less and less stable, as it becomes more and more grossly warped. They're going to have more and more opportunity to realize what's going on, so they needed something to convince them. So the question for the central banksters and the corrupt politicians was, how do we stop depositors from taking their money out of the bank, particularly when they are seeing that the crazy bets that the banks have made with their money are turning sour and threatening to bring down the banks? How do we stop them from then running to the bank and pulling out all their money, the money that we want to trap in the system, particularly today as we go forward towards central bank digital currencies? They want to trap everyone in the system to ensure that when the banks do fail, their money gets taken with it, so then they can force upon them the central bank digital currency. Now, more on that later. But going back to how deposit insurance schemes began, the banks got together and they came up with this plan. And the solution, of course, was deposit insurance. So with these deposit insurance schemes, countries basically commit in advance to guaranteeing some or all of the deposits of failed banks, usually through legislation, so it's usually put into law. Now, between 1974 and 2003, the number of countries with this kind of deposit insurance grew sixfold, and that was from 12 to 88, and of course today there's even more than that. So most countries today have partial deposit insurance schemes. They exist in Europe, Central Asia, America, Latin America, the Caribbean, and some countries actually even offer full deposit insurance. So this is the idea that if there's a systemic banking crisis, the government or the deposit insurance scheme will step in and refund you all of your lost money. Now, you've got to remember that these financial compensation schemes, the deposit insurance schemes, whilst they're touted as increasing financial stability, actually they have the complete opposite effect. Just think about it for a second. Deposit insurance schemes ensure that the bank has zero responsibility for ensuring that it protects its customers' money. Doesn't have to, because there's a scheme there that's going to bail out the customer, apparently, if there's a financial collapse at the bank. So they have zero liability. They literally have no liability for losses now. Of course, this encourages banks to invest those deposits with absolute irresponsibility. It's like the equivalent of a son or daughter of some rich tycoon who lives off the bank of mummy and daddy. They know 100% that if they screw up, then mummy and daddy will step in to bail them out. And that is how banks behave these days. And they've ensured that through legislation, they've enshrined a position where they can socialize any losses back to the taxpayer. And that's why the banksters like to put politicians in power that they can use to create new legislation that protects the banks. Not us, but it protects the banks. And right now, we've got Rishi Sunak as Prime Minister in the UK, just announced this week. And where does Rishi Sunak come from? Morgan Stanley. He is an ex-bankster. Look at France. Look at Macron in France. Where does he come from? The Rothschilds Bank. He's an ex-Rothschilds banker. Look at Kwasi Kwarteng, who handed Liz Truss the poison chalice budget. Where did he come from? Ex-JP Morgan banker. So this is what happens. The bankers get the politicians on their payroll, they put them in positions of power, and then they enact legislation that protects the banks and socializes the losses of the banks by forcing them onto people like you and I. So we always lose and they always win. That is why it happens. So this actually has a name. It's called moral hazard, and banking is full of it because corrupt bankers, by manipulating politicians, have managed to push through all this legislation that literally absolves them and the wealthy shareholders of the bank that they can never ever lose. They can make as many big bets as they want, and if they win, they get to share the profits out between themselves. But if they lose, then you pay for it. Of course, you don't get any of the profits, you only get the losses. That's how banking works. So we've got all these banks out there now, and through bank deregulation, they're allowed to make all these high-risk bets at the casino, at the Wall Street casino. And if these high-risk games go wrong, then what happens? Then we have to bail them out. They're using our money to make the bets to earn profits for the wealthy bankers and the elites. And when it goes wrong, they push it onto the taxpayer. Then you and I lose. Because then what happens? Our governments then have to go to the central bank to lend even more money, which debases the currency. So we get shafted from all angles. That's how it's working. So this is one of the reasons why deposit insurance schemes and the financial compensation scheme, these are a con game. It enables the banks to behave with absolute impunity with regards to their actions. In a world with no deposit insurance, a bank that is considering making a risky loan knows that it would have to pay depositors more for taking on the added risk. Just think about it for a second. You wouldn't lend your money to a known gambling addict who you also knew had a drug addiction and you saw every day spending all the money, just getting rid of it and always broke. You wouldn't lend your money to them. And if you did, you'd want an interest rate with thousands of % in return to make it worth taking that risk, because you would know the risk of loss is so high because of the way that person is using the money. You'd think, I want a lot of % back. I want thousands of % to make this risky bet. Well, it's the same with banking. Without the deposit insurance schemes or the financial services compensation schemes, either the bank would have to pay you a massive risk premium in terms of interest rates for your deposits to make you feel comfortable leaving your money there, or at least happy taking the risk, or they would have to behave responsibly, because they would know that if they do not behave responsibly, nobody is going to put their money in that bank, not without a massive risk premium. So you can see the rock and the hard place the bank would be in. They would have to behave responsibly, and that would work because you would take your money out of the bank and go elsewhere. However, if you put deposit insurance schemes in place, then what happens is the bank can go away, make as many risky bets as it wants, not pay you anything for taking that risk, because the bank will say to you, oh, you're protected. You're protected by the FSCS guarantee scheme. It's all safe. And you believe that. You think you are protected. So then you don't even look at what the bank is doing. And most people today have no idea what the banks are doing with their money. They have no financial acumen at all. They think, if I put my money in the bank, it's safe. They don't even realize that they are lending the money to the bank. That when they put their money in, they've lent the bank that money. And that bank can then go away and use that money to make bets in the financial market, to buy derivatives, to do all kinds of things. And that's why people today are willing to lend their money to the bank by putting their money in the bank in the form of deposits. They're lending the money to the bank and they're doing it for an interest rate of less than 1%, despite the banks taking massive risks with their money. So this is the second big problem with deposit insurance. It's the false trust that it breeds in the everyday man and woman, because explicit deposit insurance significantly reduces incentives by depositors and shareholders to monitor what their banks are doing. In our minds, it's all okay. We don't need to take any interest in what the bank's doing because we're insured. And of course, the banks absolutely love this because they can put over all their material, we are covered by the FSCS guarantee scheme. So your deposits are covered and you're safe by putting your money in this bank. And for most people, that's enough. They can then switch off and think everything's good. Well, it isn't good, and I'm going to prove that to you in today's video. Now, as bad as those things are that I've already mentioned, they are nothing compared to what I'm going to tell you next. We haven't even gotten to the shocking part yet, my friends. Now, the biggest problem with deposit insurance schemes is neither of those things that I just mentioned. The biggest problem with deposit insurance schemes, with the Financial Services Compensation Scheme, is that fundamentally they are based on a fraud, on a deception, on a very, very big lie. Because ultimately they are designed to convince depositors like you and I to not worry about our money when it's in the bank, and to not panic and not remove our money from the banks when we hear about the risk of financial collapse, or we hear about banks going under, or we read headlines about the pension funds almost going bust. The scheme is designed to trick us into thinking that therefore our money is safe. And we keep our money in the banks as we see things around us start to fall apart, as we see the global financial system start to come collapsing down. They expect you to believe that your money is still going to be safe. And that is the con that I'm going to expose today. It is not safe, and I'm going to tell you why. Now, I even see this on YouTube and on FinTwit. There's lots and lots of alternative financial media sources out there. Trusted sources, people mention them in my comment section all the time. Lots of big channels. However, lots of these channels also say, oh, if you want to protect your money, just make sure you don't put more in the bank than is covered by the insurance schemes. And they believe themselves that these insurance schemes are going to work. Well, they're telling their audience something that is extremely dangerous. They haven't done their homework. So what I'm going to show you now is why these schemes will 100% not protect you in the coming financial collapse. You will lose 100% of your money if you have it in the bank during the coming financial collapse, and I'm going to explain to you now why that is. So the way I'm going to do this is I'm going to take you step by step through Great Britain's Financial Services Compensation Scheme. So this is the scheme that we have in Great Britain. So let's just have a little look at their website. Here is the page where it shows you what they cover. So you can see here that in the UK, you are insured on your bank account up to £85,000 per eligible person per bank, building society or credit union, and up to £170,000 for joint accounts. So this is what people are led to believe is going to keep them safe in a financial collapse or the collapse of a bank. This is the scheme in the UK. Now, it's important to understand that this scheme is not governmental. Although it was legislated for by government, the government and the Bank of England have nothing to do with this scheme. It's a private scheme. It's a separate business that works for the government. So you've got to understand that. This means the money is not coming from the government. The way the Financial Services Compensation Scheme is funded is through what we call levies. And this is basically an income that they get from the financial institutions who get to use their logo on their material. So that's where the money comes from. It doesn't come from government, doesn't come from the central bank. It's an independent scheme. And the money that they take in the form of levies is what they then use to pay out the compensation. So you have to understand that it's an independent body that the government creates, but then is hands off on. It says, right, now you need to earn an income, and from that income, you can pay out the compensation. So this is where it gets really interesting, and I'm going to take you through the figures now of just how much money they're taking in and just how much they're spending in an average year. So let's go to the FSCS annual report for 2021 to 2022. This is the financial year between 2021 and 2022. And let's just find out just how much money they're earning. And you can see here, there's this part that says levy income. And what it says is that in the year 2021 to 2022, the total levy income for the year was 643 million. So that's how much money they took in during the year. And that's how much money they had to give out in compensation. Now, compensation costs for the year were 584 million. 584 million of the 643 million was spent paying out compensation to people who lost their money because either a bank failed or a credit union or a building society. Now just think about that for a second. That's a normal year. That's a normal year with no systemic banking crisis, no huge financial collapse, just a normal year. They are paying out 90% of their entire funding in a normal year on compensation. Just think about that for a moment. 90% in a normal year is spent. That leaves just 59 million remaining for a normal year. So you're probably already starting to see there's an accounting anomaly there. They're supposedly protecting every man, woman and children in the UK from having their deposits lost in a financial crisis. But what happens if there's a systemic financial collapse where lots of banks fail at once? Well, like I just showed you, in a normal year, they pay out 90% of their funding. So if there's just a slight increase in crisis, I'm not talking about a major global financial crisis. I'm talking about a year when just something like a black swan event occurs, then already the fund goes bankrupt. Immediately the fund would be bankrupt. Now, of course, we know that what we are heading towards right now is a financial catastrophe. In fact, what we're going to see is the collapse of the global monetary system. And the reason for that is there is so much debt in the system right now that there is only one outcome. The only outcome now is financial collapse. And we almost saw that just the other week when the pension funds in the UK almost collapsed and the central bank had to step in to bail them out. Well, what we're seeing right now in Europe is the collapse of European industry because of the war, because of energy prices, and because of governments creating crazy energy policies. In Germany, just the other week, we had 6 giant mega companies go under, and these companies have been around for over 100 years. They survived World War I, World War II, the Weimar hyperinflation, famine, but just a few months of this proxy war, the US destroying European energy, has led to them going under. This is how serious it is, and we're going to see wave after wave of bankruptcy, insolvency, and then of course this is going to bring down the banking sector. The government, of course, is going to step in, and the central bank. They're going to bail out the banks. However, that is going to hyperinflate the currency, because you can't just print money to backstop a system, a giant Ponzi scheme that has hundreds and hundreds of trillions. In fact, it's quadrillions of debt, including derivatives, and derivatives were what nearly brought down the pension funds. There's quadrillions in debt. So once this system starts to unravel, I call it the great unraveling. Once it starts to unravel, there's so many counterparties and interdependencies that once the first domino falls, it ripples through the system and we have a big debt collapse, and that's what's going to happen. So what you need to understand is the financial services compensation scheme is severely underfunded. Even if it could save you, the money doesn't exist. The money is not there. The simple fact is this scheme, the financial services compensation scheme, and all the others, the ones in Europe, the ones in the US and Americas, they were never ever designed to protect people during a systemic banking crisis or a financial collapse for that matter. They were designed to convince you to feel safe, just to feel safe leaving your money in a bank. We know that in 2022 it's all about how we feel. Well, all they care about is that you feel safe leaving your money in a bank. It was designed to convince you to feel safe when you saw things like what we saw the other week when the pension funds almost collapsed. Now, that should have been the trigger. In a normal, critically thinking, rationally thinking mind, that would have been the trigger for people to think, oh my God, I need to get my money out of there and put it into something that cannot be printed. Get out of this paper money, put it into something like gold, like silver, like land, anything that they cannot print to protect myself, because I can see what's coming now. I can see what's coming. It almost just happened. But instead, people go along like normal. It's business as usual. And this scheme is why they believe that their money is protected. But it's not. It's a banker's scam, and it's used to trick people into trusting them so that they can continue to take extraordinary risks with their money and have zero liability. And when those bets fail, the bank will not lose. Its wealthy shareholders will not lose. They will have already exited through the back door. They'll have sold their shares. They will have put it into real things. Just think about what they do with their money. Look at the monarchy in the UK. They have lots of palaces, lots of artwork, lots of land, lots of rental properties, lots of precious metals, lots of jewels. That's what they do with their money. They are protecting themselves. They take the profits from the paper money system, from the fiat Ponzi scheme, and they invest it in real things, whilst you and I have our money put into paper Ponzi schemes, and we are told, we are promised that it will all be okay. Well, it's not going to be okay. I'm very sorry to say that, because when it all goes wrong, it's bail out for the banks. Yes, it's bailout time. They get to bail themselves out with taxpayers' money. They are considered too big to fail, and they get central bankers in power and politicians in power who will then do their bidding and tell the government, oh, we have to bail out the banks. They're too big to fail, and we don't want all those poor people to lose their jobs. And of course, the propaganda in the media tells the public that there was no other choice. There was no other choice. and of course the banks get bailed out and the losses are put on to us. Of course, now the corruption is so bad and so grotesque, and our politicians are so corrupted also, that they have even been allowed to legislate that in the next financial crisis, not only would the banks be bailed out by taxpayers in the form of the government giving the banks the money and us having our currency debased, which means we have massive inflation. No, it's much worse than that. They can even bail in the banks now with our deposits. Yes, they can take your deposits that you've put in the bank and give that to the bank to bail them out. They can do that now. It's legislated for. The Bank of England have already legislated for it. You can see the document in front of me. I did a previous episode on this, which I will link in the description. Also, the Federal Reserve in America, the European Central Bank, they all have legislated for bail-ins. And these things are already taking place. It's happening right now in Lebanon. It's already happened in Cyprus. It's already happened in Greece. These things are going to be used in the next financial crisis. They're setting up for it now. But again, the central banks will say to you, don't worry. Even though we've legislated for bail-ins, that would only happen to people who had more than the insured amount. So if you're insured using the FSCS financial compensation scheme, you will be fine. We cannot take that money legally in a bail-in. However, if you go to the Bank of England's website and look at the Freedom of Information Request section, using Freedom of Information requests, which by law they must answer, what you get is a slightly different picture. So it says here, deposits that are protected by the FSCS scheme are legally excluded from bail-in. This generally includes deposits up to the amount of £85,000 per eligible person, which I showed you before. This means that depositors who are fully protected by the FSCS scheme will not lose money in a bail-in or any other kind of bank failure. With respect to depositors whose deposits are not fully protected by the FSCS, bail-in would be applied in accordance with the insolvency creditor hierarchy, which is basically the hierarchy of who bails in the bank first. And if it's a failing bank, everyone would be bailing in the bank. This sets out the order in which shareholders, creditors and depositors of a company would receive recoveries should a bank be placed into insolvency. So all it's explaining there is what I've already told you. They say to the public, don't worry, even in a bank bail-in, which we have now legislated for, which we are definitely going to do. Like I said, it's already happened in many countries. So when the next financial crisis happens, and we're on the precipice of it right now, they're going to bail in the banks with our money. However, they are saying if it's with a normal bank, you're protected up to £85,000. And for most people, they think, oh, that's great. If I've got more than £85,000, I'll just put it across different banks so that each account is protected up to £85,000. And you could do this with many different banks. And that is often the advice you hear other people say to people. These channels on YouTube often say to people, just do that and you're still protected. Now, I'm going to give you 2 reasons why that is a lie. So let's go back to this Freedom of Information request. One of the questions that was asked of the Bank of England was this. The FSCS bank protection limit is £85,000. Does this mean that no money under the amount of £85,000 would be taken under bail-in rules, or do bail-in rules override the FSCS scheme? So this is a very specific question because the banks always repeat that your deposits are protected up to £85,000, and even in a bail-in, they would not be used, they would not be touched. However, what this person is asking is for the bank to state categorically that no money under that threshold would be taken. Now listen to this response. The Bank of England works with the FSCS particularly when we have concerns that a firm is at risk of failure. Our resolution regime operates alongside the depositor protection regime. If a firm's failure would otherwise result in the losses for depositors, the FSCS will protect eligible depositors up to £85,000. So yet again, they just repeat the same line. But the person who is making this Freedom of Information request presses them even harder. And I really like how they worded this one. So just listen to this bit here. It says, how safe is the FSCS bank protection limit? If multiple banks get into financial problems at the same time, will there be enough money in the scheme to cover all potential customers' money? Now, the Bank of England responds, the FSCS is funded by levies paid for by firms that are authorised by the PRA and the Financial Conduct Authority. Further information is available in the FSCS annual report. Now, of course, I've already looked at the annual report. I've already taken you there, and I already showed you that in a normal year, 90% of their entire budget is spent compensating people. and there was just 59 million remaining this year in a normal year. So let's just take the full figure for this year then, 640 million for the year. The Bank of England said, go have a look at their annual report. Go have a look at it. So they're not going to tell you just how underfunded it is. They want you to figure it out yourself because they know most people are not going to. Well, I've figured it out for you. And I can tell you that the Financial Services Compensation Scheme is funded to the tune of about £9 in an average year. If they didn't spend anything, there is £9 for every man, woman and child in Great Britain. That is how robust the scheme is. So let's just imagine a systemic banking crisis. Then what would happen? What would happen? They say to you that you are covered up to £85,000, but this is just the same banker's contract that they have when you put your money in a bank. You put your money in there and you believe that the bank is capitalized enough to allow you to withdraw your money at any time. Well, the insurance scheme is just the same. It's a contract. They're telling you that you're insured up to £85,000. However, if lots of people needed to use the scheme, it would go bankrupt within hours. In fact, it would go bankrupt within minutes. There is £9.04 in that scheme for every person in Great Britain. So in a systemic financial crisis where you have the pension funds blow up or you have banks start to fail, the scheme fails. The scheme goes bankrupt. So you've got to understand this scheme is a lie. It's a complete fraud. It's there to convince you to keep your money in a failing system. But you might say, Mike, but the Financial Services Compensation Scheme existed in 2008 when we had the Great Financial Crisis. Now, what I'm predicting is way bigger than that. However, let's just take a look at 2008 and what happened to the scheme in this situation. So what you can see here with this timeline is how much the scheme was paying out each year. And you can see it was 41 million in 2001, 194 million, 198. Now you can see 2007 to 2008 was 83 million. Then we had the Great Financial Crisis and all of a sudden the scheme had to pay out 19 billion and 860 million. Now remember, this was not the Great Financial Collapse I'm speaking of because they stepped in and bailed out the system. It was a 23,827.7% increase year on year in the amount of people that needed to be bailed out by the fund. Now, how did they do it? How did they do it? How did they achieve that? Because back then, the levies they were taking in was even less than they are today. Like I said, today, they're taking in 643 million per year. Back then, it would have been even less. So how the hell did they come up with 19,860 million to bail people out? Well, it's very simple. The government loaned it to them. Yes, let me repeat that. They had to take out a loan at interest from the government to pay people back from the scheme. Just think about that for a second. The government cares about you that much that it loaned them the money. Didn't give them the money, didn't bail them out like they bailed out the banks, didn't just print the money, it loaned them it at interest. And you can see here on the Financial Services Compensation Scheme website, they explain what happened as a result of the financial crisis. So like I said, there was a 23,000, almost 24,000% increase in the amount of compensation that they had to pay. They didn't have the money because I've already explained they are massively undercapitalized. There is £9 in that scheme for every British citizen. So they had to lend the money from the government. They lent over 20 billion from the government, but they managed to recover 20 billion from the failed banks. So it says we recovered 20 billion from the failed banks of the 20.9 billion in compensation they had to pay out. But how did they recover 20 billion from the failed banks? You guessed it, it was a bailout from the government. So here's how this whole corrupt event unfolded. The banks took excessive risks and they ended up going bankrupt in 2008. So they went to the government, the Great British government, and said, we need a bailout. And of course, because the British government is corrupt, it's full of ex-bankers, it's full of politicians that are sponsored by the wealthy elite and by the bankers. So of course the government said, okay, we're going to bail you out with the taxpayers' money. Remember, it doesn't come from the government, it comes from you and I, from our taxes, and also from when the government lends money from the central bank, and then that debases the currency supply and inflates it, and you have to pay higher prices in the future through inflation. So whenever they bail someone out, it's you and I that pays for it. So the government said to the banks, we're going to bail you out. But whilst this was going on, the FSCS guarantee scheme had to pay out to customers. And of course, as you know, they didn't have the money for it. So they went to the government as well for a bailout, and they said, listen, we've got about 100 million, but we need to pay out over 20 billion to depositors of banks who have lost all of their money. So the government said, okay, we're going to bail you out. So they gave them a loan with interest attached, might I add. So they gave the FSCS compensation scheme a loan. Then they bailed out the banks, who then gave the FSCS compensation scheme some of that money, not all of it, some of that money back. So that is how the FSCS compensation scheme managed to survive the 2008 financial crisis. It was all because the government backstopped everything. However, that came from your pocket. You paid for it. And of course, there was a decade of austerity after 2008. So you was punished for it. The most poor and vulnerable in society were punished for it because their services got cut. And of course, you paid for it in inflation. So the FSCS compensation scheme really was bailed out by you. And of course, they told you that everything was fine, that people got bailed out. No one lost any money. It's a lie. Everyone lost money because when the government bails out the banks, they take it from you. When the government bails out the FSCS compensation scheme, they take it from you. And let's not forget, they gave the FSC compensation scheme a loan. And when they paid the government back that loan, they also had £3.5 billion worth of interest that they also had to pay. So the government actually turned a profit on this whole scam as well. They got 3.5 billion and you and I got shafted. And this has been going on for many decades. In fact, during COVID, the same con game was done yet again. The government got the commercial banks to give out loans left, right and centre. And the government backed these loans with government guarantees. All these big companies that were in a terrible financial state, they all took massive loans. And these loans were government backed. And this happened all across Europe. And what does government backed mean? It means taxpayer backed. It means that you and I, as the taxpayer, have to pay for it through taxation and also future inflation. Now, all of these companies filled upon all of these government-backed loans because they cannot lose. The banks cannot lose. The government backed those loans. So what does that mean? You had to pay for it through inflation. And what do we have now? We have sky high inflation in the UK, 20+%. And now you know why that is. It's because the government has been printing money to bail out banks and bail out big business. It's a scam. Now let's go to Exeter's pyramid. Now this is what I always show people when I'm explaining the coming financial collapse. Now what you can see here is the global debt time bomb. There's 2 to 4 quadrillion in derivatives and unfunded liabilities. Now unfunded liabilities are government promises that they do not have the money to pay out. These are things like pensions, social security, and there are trillions of them. Trillions in unfunded liabilities that will never ever get paid. That is one reason right there why the financial system has to come down. They don't have the money. Unfunded liabilities. Now the derivatives, there's 2 quadrillion of them minimum, and these derivatives are the most toxic financial product out there. Now you'd think that financial institutions that handle our money, that are supposed to look after our money, would not use these derivatives. However, what we found out just the other week is our pension funds, what should be the most secure investments out there, they should be the most secure of all investment types, because you are entrusting them your financial future. So they should only be invested in things that are safe and unlikely to go bust. However, they are filled with derivatives and they almost went bust the other week. So this should start to highlight to you just how bad things are. Now there is also 300 trillion in other types of loans and debt. And when we have the next financial crisis, and that is beginning right now, we're already seeing it. Like I said, we're going into a Great Depression. The UK is going to have the most severe recession of the G20. So the UK is done for. Europe is done for, industry is collapsing, so we're going into a Great Depression type situation. Lots of people are going to go insolvent, they're not going to be able to pay back that debt. Then what will happen is the counterparties to that debt, which will be the banks, same thing happened with pensions when they started to go bust. The banks who had loaned them money, who were on the other side of the derivatives trade, said, now we're going to go bust. Well, the same thing's going to happen when all of these industries go bust this winter. The same thing's going to happen. And then beneath that, of course, you've got equities, the stock market. There's trillions in the stock market. Most people's pensions are invested in the stock market and in government bonds. If they collapse, the pensions collapse anyways. The value of those pensions will disintegrate. You could lose 80 to 90% in just a few years. That's what happened when the stock market bubbled in 1929 burst. The stock market lost around 90% and it took over 24 years just to break even again. So if you're banking on your pension being there in 5 to 10 years, I'm sorry to tell you, it's not going to be there. Government bonds. It used to be that government bonds would protect you if the stock market went down. When the stock market went down, government bonds went up. When government bonds went down, the stock market was going up. It was called the 60-40 portfolio. No more. Government bonds and the stock market are going down together. So probably you're already starting to get an idea of just how bad this is. When the next financial collapse happens, people are going to be wiped out. And the financial services compensation scheme or any other deposit insurance scheme that you've been tricked into believing is going to protect you is not going to protect you. The money is not there. It simply doesn't exist to begin with. All that scheme is good for is during normal times whilst the system remains somewhat stable. But the moment we get into a financial crisis, nobody is going to care about these proxy schemes. The whole system will be coming down. Those schemes will be bankrupt within hours. And the only way the government would be able to solve that is to print the money. They could print the money and give it to the people to bail them out. However, if they print the money, what's going to happen? Well, if you go up 3 from the bottom on Exeter's pyramid that you see in front of you, you can see paper currency. There's 40 trillion in existence now. But in essence, that paper money can go to infinity. They can print that money and give it to you and say to you, we've bailed you out. You've lost 20 grand in your bank account. We're going to give you it back. But if they did that for the entire system, for everyone who loses money, what happens to the paper currency? It hyperinflates. It becomes worthless. That £20,000 won't buy you a loaf of bread. And you can see here a chart from the Weimar hyperinflation. This is German CPI on a log scale. And you can see it just went through the roof. Now that's already begun this year. Right now, German CPI is around 59%. So we're already entering the hyperinflationary stages of this game. And you can see here on this chart, this is the value of gold in paper marks. So the German mark, this is the value of gold. And you can see, because gold is a real thing, it takes a lot of human energy to get out of the ground. In a hyperinflation, the value of gold just skyrockets through the roof. You can see it just goes up and up and up. And of course, nobody sells gold in a hyperinflation. They use gold to protect themselves because the paper money is hyperinflating. It becomes worthless. So going back to my Exeter's pyramid, you can see that in the coming financial crisis, we're going to have all of this debt cascade through the system. And the only thing that's going to be left is things at the bottom. So land and commodities. Now, of course, land and commodities are usually situated within a country. So there is even a counterparty risk there. You could have your land confiscated. You could have your house confiscated. If you own commodities, the government could say, well, it's wartime now. We need to take those commodities. These are things that have happened in the past. The only thing in this that have zero counterparty risk are gold and silver. And the reason for that is you can take them outside of the financial system. You can take them outside of the system and you can move them around. Of course, there is also Bitcoin too and other cryptocurrencies. Some people want to put their money there as well. Of course, they are extremely volatile. They do not have the same history as gold and silver, but they could be useful also in a coming financial collapse because they are outside the system, zero counterparty risk. So there you have it, everyone. On that bombshell, I've just completely dismantled the financial services compensation scheme and all deposit insurance schemes. And I need you to understand that these schemes are not going to protect you from what's about to happen. They cannot protect you. They are not funded enough. They are there as an illusion to trick you into staying in the system whilst it comes collapsing down. Now, why would they want to do that? Well, of course, they want to keep you trapped in the system because they want to control you. And their agenda is to go to central bank digital currencies. Now, the only way they can force people to go to central bank digital currencies is to ensure that people are fully dependent on them already. And of course, they'll convince the general population it had nothing to do with decades and decades of corruption and lies. They'll say it was because of war or because of something else. But when that happens, they are going to be trapped in that system because their bank deposits will get stolen. The money will hyperinflate if the government steps in to backstop the system, which I think they will. And then what they'll say to people is, listen, we're going to ride in on a white horse and save the day. Here we have central bank digital currencies and we're going to give you this currency. We're even going to top up those bank accounts for you so you can go out and buy food and you can go out and use it. However, we all know that central bank digital currencies are the next step in slavery. Once you get a central bank digital currency, you will be 100% controlled by the banksters. They will be able to tell you where you can go, how much you can spend, and you will have no escape from the system. You won't be able to use physical cash and money anymore because that will get destroyed in the hyperinflation and it will never come back. It will never come back. So it's not as easy as just saying use cash now. Of course, that's great to use it, but they're going to engender a crisis, in my opinion, that gets rid of all the cash anyways, and that's going to be a hyperinflation. The reason they have to hyperinflate is because the system is so fragile. And financial crises are just going to keep happening and happening and happening because the system is meta unstable. Now, I really want you to share this video with other people. Anyone you think could benefit from this, please share them this video. And of course, if you want to learn more about how you protect yourself and your family in the coming financial collapse, then stay tuned on this channel. Of course, you can also come and join me over on my Patreon, which is where I share lots more in-depth information with my community about how we can prepare for the coming financial collapse. Also, the collapse of things like food supply chains, healthcare. We talk about all of these things, how we protect ourselves financially. We're also building a community of like-minded people. So we're going to have a private Telegram group over there. And I believe that in the future, the biggest asset for you and I is going to be one another. It's going to be building a parallel system where we can stay in touch with each other, we can support each other, we're going to have connections all across the world. So if we have to get out of Dodge, if we have to move to another place, we'll already have a community. And this is what I'm building through my Patreon. And so far, so good. We've got some great people over there. So that's it for today's show, everyone. Thank you for watching. I hope you found this video useful. Like I said, please share it with anyone that you're worried about, anyone that is not up to speed on what is going on. Share them this video and it may just awaken them to the risks that they are facing. Of course, they might go then down the rabbit hole, watch some other videos, and who knows, you may have another ally on your side to help you in the coming financial collapse. As always, thank you for watching, and I will see you in the next one.